So before I start, how many people here have invested in the blockchain? Okay. How many people have participated in ICOs? Okay. How many people have invested in kind of above five companies related to the blockchain and consider themselves knowledgeable in the industry and the technology? Okay. Okay, so most of the people here, I understand, are kind of coming to learn more about the industry. And my goal for today is that everybody walks out and has a little bit more information about this industry. And hopefully after the presentation, we'll have time for a bit more questions. And so everybody can kind of feel good about this, this little meetup. So I'm going to start by saying that every decade or so, there is a massive opportunity to create wealth. And I strongly believe that we're in one of these points in time. A little bit about tokens and currencies. So tokens actually date back to 3,000 years ago when they were based mostly on commodities. Then there was an evolution to representative money, which is basically commodities that their representations are stored in banks. In 1971, Nixon has decided to basically break the peg between the dollar and gold, and that actually opened the door for fiat currencies. Fiat currencies are currencies that are issued by governments and have no intrinsic value. All of their value is based on the fact that the government issued the currency and the people are using it.
On confidence.
On confidence, exactly. And in 2009, the first decentralized digital currency, which enables people to transact in real time, borderless, has emerged, Bitcoin. And basically, Bitcoin has opened the door to blockchain and everything that's going on today. So, Lee, what is blockchain? Blockchain is basically the technology that enables the transactions of Bitcoin and other cryptocurrencies. And if you think about it a little bit, take, for example, the internet. The protocols of the internet made it very easy for us to share data. But the reason we couldn't use internet as a blockchain until now was because it only enabled us to share data, but there was nothing in the protocol that enabled me as a user to know that if I receive something from somebody else. For example, Ophir sends me something. I can't know that he didn't make a copy of that for himself and sent it to other people. So this is basically where blockchain comes in. And the way it works is actually quite simple when you think about it. Let's say I rent a house to Ophir or to Guy, because I gave you as an example already. So that transaction gets recorded on a computer network and gets broadcasted to everyone. The transaction gets time-stamped. At the same time, other transactions also occur. They're also time-stamped, and then they're chained together into a block. The block itself is also time-stamped. So that way, it keeps track of all the transactions that occur within the chain. And at this point, there is the component of the security. And the security of the blockchain basically comes from the hash. A hash is a piece of cryptography that basically uses information from all the transactions within the block and is pasted on the block itself. Now, a piece of the hash is also used for the subsequent block. And what this means, what happens is that if someone tries to alter the block, then everybody in the network is going to see it. And if everybody in the network is going to see it, that basically means that based on consensus, they're able to disregard the transaction or the occurrence of someone altering the blockchain. So basically, the blockchain has two important functions. One is to collect data, and the other one is to encrypt it and secure it. So So why is it so significant, the blockchain? The significance of the blockchain is basically the fact that throughout history, as a society, we've always relied on trust in order to do things. If it was through brokers or through governments or through intermediaries, we had a trust issue. And now the fact that there is a technology that enables people to collaborate together in a consensus, there is basically no more need for intermediaries in certain areas. Now, how is this done exactly? It's done through smart contracts. A smart contract is basically a code snippet that we can attach to a blockchain. Basically, the code is written in code and not in language. But the idea is that you can do an if function, then. So the best way to think about it is imagine a vending machine. With a vending machine, you use coins. You can put the coins in a vending machine. And based on what you choose and the prices, the vending machine dispenses product and change if needed. Now, anybody who has a coin can participate, can use the vending machine. And different mechanisms and securities related to the vending machine make sure that the products and the coins are stored properly. And basically, it enables profitable distribution of the vending machine throughout the world. So smart contracts on the blockchain, very, very similar concept. For example, upon receipt of payment, ship product to address. Or if money is stored, upon lapse of 1 month, pay interest of LIBOR plus 2%. So it's that simple. Now, actually, the first company that was created, that created a protocol around smart contracts is Ethereum. And today, most of the decentralized applications that do some of the things, or some of the applications, even the ones that I mentioned today, are coded on top of the Ethereum protocol. So what do we do with this technology? So first of all, banks are the obvious beneficiaries of this. And the reason for that is that banks are very, very traditional industries, very traditional intermediaries that are bogged down by a lot of legacy systems. And a lot of their processes are basically prone to error and a lot of bureaucracy. And so blockchain can solve a lot of the issues that they face today. For example, if I wanted to transfer money, let's say to Mark, who lives in Baltimore, it would actually be easier for me, just from a time perspective. It takes the exact same time for me to withdraw cash from a cash machine, get on a plane, fly to New York, get on a train, and give him the cash in person than it takes to settle a wire transfer from Israel to Baltimore. And this doesn't make sense in today's world, and now that we have technology like blockchain. And when you think of the stock markets, it's also a very similar use case. Stock markets today, the whole settlement process is very bureaucratic. And the reason is because there are a lot of people, a lot of players involved in many different places, and each of these people have their own separate ledger. So a lot of time and resources are spent on reconciliation and risk management. But theoretically, today with blockchain, if you create a blockchain and you give the participants securities that are backed by tokens, and you have notarized ownerships and issuances, then technically you don't need these intermediaries anymore. You don't need custodians, you don't need registrars, you don't need clearing houses. And this is really where the world is going. We're actually in the process where a lot of business developments have been made in this respect. But smart contracts actually open the door to many decentralized applications. So it's not just fintech that's benefiting from blockchain. And the reason goes back to the premise that blockchain enables us to interact with each other without having to worry that we need the trust between us. These are some of the examples of companies that are developing projects on the blockchain. You see media, you see legal, you see content, you see data analytics. And it's extremely exciting when you think about it, because blockchain, it's not only changing technology, or it's not only enabling us to have a better banking system, but it's really changing the way we collaborate with each other and we do business with each other. So it's really changing the world on a consumer level. That's why I like to kind of think about it as almost like investing in Apple before the iPhone, because the blockchain is going to create an ecosystem that's going to change our lives. One example, by the way, is the fact that today people can very easily organize into what we call DAOs, which are decentralized autonomous organizations. And it's almost like smart companies where we can organize as companies, and all the incentives are dictated by the blockchain, the incentives and the transactions. Another example is the Internet of Things. You know, in 5 to 10 years from now, we're going to have a chip economy, and everything is going to be able to communicate with everything, anywhere, anytime. In 5 years from now, imagine yourself, your refrigerator ordering groceries for you, or your self-driving car self-fueling, or your laundry ordering detergent, or me going into a shop and not even having to go through the POS system in order to take a dress that I like. And for that to happen, you actually have to have an underlying methodology and an underlying technology which enables this seamless transacting. And that's also something that's going to be powered by the blockchain. So, sounds very exciting, obviously, but everybody's probably asking themselves, okay, but how do we make money from the blockchain? In order to understand how people are able to make money from the blockchain, it's very important, first of all, to understand the difference between the blockchain and the internet. The internet, basically the early protocols of the internet, like HTTP and SSL, these were all protocols that weren't monetized. It was always the application layer on the internet that was monetized. When I talk about application layer, companies like Google and Facebook basically use these protocols through a very seamless UX to monetize on our attention and our sharing and the content we create. Now, if you imagine Facebook as a decentralized organization which issued a token, participants in Facebook would be able to receive compensation or tokens for the content and the value that they contribute. Because when you think about it, we contribute a lot of the content to Facebook, but we don't really get any of the value. And that's one of the issues that blockchain has. Also, as it relates to privacy, as we know that companies like Facebook are selling our data. And we recently invested actually in a company like Kin, in a token, Kin, that was created by Kik, which is a social messaging platform. And the ICO actually just closed a couple of days ago. But it would be very interesting to see what happens. Because if a network equity-based business model emerges from this and is actually successful, it will incentivize more traditional companies and more entrepreneurs to come up with this new business model and can potentially become an Achilles heel in some of the incumbents. So wait, keep it on the other slide. The blockchain, on the other hand, creates value through the protocol and the application level. So for the first time in history, people are actually able to own a part of the protocol. They're able to buy into the protocol. And the way it works basically is through an access token. If I'm an entrepreneur and I want to create a protocol, I basically incentivize early adopters to buy my token. And they use this token in order to transact within the network. Now, what this creates is a fat protocol level. Like when you think about Bitcoin, Bitcoin's current market cap is $70 billion. But all the applications created around Bitcoin are only $1 billion or so. So you can see how the protocol of Bitcoin is huge, while the application layer is very thin. Same thing when you think about Ethereum. Ethereum is basically a protocol network that enables people to create decentralized applications within the blockchain. Now, Ethereum is worth about $30 billion, but none of the applications, the decentralized applications that were created on the Ethereum network are yet even close to being valuable as much as Ethereum. So there are two reasons that this happens. The first reason is the data sharing element of the blockchain. Basically, almost all the blockchains are open source. So what this does is that everybody has all the information, there are no silos, and this lowers the barriers to entry because everybody can come in, look at the same data, create the same business. So what it happens from an economic perspective is it incentivizes all the participants, all the application developers to be more competitive, to create better products for cheaper. And the early adopters of the protocol have an incentive to create these applications because they know if they create an application which will have adoption, it will drive more value creation at the network level. So this is how the protocol becomes much fatter and much distributed over a larger community of stakeholders. And what this does is that as the value builds at the protocol level, it incentivizes more entrepreneurs to come in, potentially VCs, investors, more developers, and then it becomes a virtuous cycle which makes the protocol grow. And this actually brings me to the next topic of ICO. ICO is basically a token generating event. If I want to create a network or an economy on the blockchain, the way to issue a token is through an initial coin offering. Now, initial coin offerings, I mean, they take a lot of trends that we know of today, like crowdfunding, like viral internet, technology advancements, fintech, VC, and capital markets, all kind of lumped together. And the idea is that through actually a similar marketing process as you see with an IPO, entrepreneurs come together and they create a white paper. A white paper is kind of the equivalent of the deck in the traditional startup world. And they're able to raise money for their protocol project. Now, ICOs, I mean, there's no one in the room that hasn't heard about an ICO. It's become extremely, extremely, extremely hard to ignore. ICOs have actually overcome traditional VC funding in the last quarter. So we see this trend becoming very, very significant. Now, of course, there's a lot of volatility ahead. And some of you, the ones who have been investing in this area, have definitely been experiencing it. And the volatility obviously comes from the fact that you're investing in very, very small projects, and there is a lot of speculation around. Unfortunately, there's also projects that are not legitimate, fraud. There are what we call whales. Whales is actually one of the biggest risks in investing in this industry. For example, if you look at kind of the Bitcoin ownership, 3% of the addresses hold 97% of the Bitcoins. So these whales are able to create massive market movements just by nature of their positions. A lot of the protocols today actually are more distributed, but a lot of the investment also into these blockchain projects come from these whales that are looking to diversify the investment from the Bitcoin that they created wealth on. And yet, there is also a ton of upside. As you can see in this chart, we're still in the very, very, very early stages of blockchain adoption. Despite the fact that we're hearing about blockchain and ICOs every day in the newspaper, and it almost seems as though everybody's in it, there are actually only between 6 million to 12 million unique wallets in the world. It's nothing, right? It's very, very, very surprising. So we're really just at the beginning. And so, sorry, keep it. And so, so the opportunity here to create value and to enjoy the upside from this trend is still very much there. And we believe that as time goes by and the technology becomes better and more scalable, and the UX is more scalable, then there is going to be massive adoption. For example, imagine a Bitcoin ETF or an Ethereum ETF. on that day that Ethereum or Bitcoin ETFs are approved, and it will happen eventually, then all the top 10, top 15 coins are going to appreciate in value by orders of magnitude. In addition, today, when you're trying to transact in coins, cryptocurrencies, Bitcoin, Ethereum, it's quite technical. A lot of times, I find it extremely technical. It takes me sometimes days to liquidate a position or to understand a certain exchange. The UX is horrible. And it almost seems like the Wild West in many respects. But as time goes by, it's going to be easier. And we really need to kind of learn from the previous .com bubble, where we saw how in the late 90s, most of the companies are no longer with us. But the ones that remained, Intel, Amazon, Netflix, these are all companies that experienced massive capital gains and winner takes it all outcomes. And we expect something very similar to happen here in the blockchain realm. So many companies are obviously going to disappear, but the winners are going to stay, and people that invested in them are going to profit a lot. So why invest? So we believe that crypto assets are, despite the fact that they're risky, they're a very good hedge to an otherwise well-balanced portfolio. And in general, for anything that you want to invest in, it always needs to be taken within the context of your overall strategy. But when you think about it, it has all the elements you're looking for from your alternative investment buckets. It's not correlated to the market. It has massive upside. It's actually not, the tokens themselves are actually not correlated to each other, which is something very surprising. We ran correlations on a daily, weekly, monthly basis, and the only correlation actually arises when there's something that's happening in the regulation, and then all the tokens are moving together. This is just an example of daily expected returns in the last 2 years. S&P, NASDAQ versus the cryptocurrencies. So we've actually been investing, iAngels has invested in around 8 companies around the blockchain, around Bitcoin for the past several years. We've been following the industry. I've been investing in the space for over 6 months now. It's been an incredible ride. I've made 3x on my investments. And we've just been compelled to kind of share our passion and share our conviction around this industry with other investors. And really our strategy is to invest both in kind of established cryptocurrencies and also emerging coins through pre-sale ICOs, but also tokens that we follow on a daily basis. Currently, even the established currencies are very, very early stage. I mean, today the market cap is about $150 billion, but it's still the very early stages, even for Bitcoin and Ethereum. We're only long. We're not taking any leverage, and the term of the investments are mostly long term. I would say that the term of the investment, long term investments, is around 70%, and we also leave room for shorter term arbitrage opportunities. So how do you analyze a token? It's actually quite similar to analyzing a startup. And there are a couple of key differences. When we're looking at the blockchain, we're looking for blockchain fit. We ask ourselves, is there really a reason for this company to be decentralized? Or what's the added value? Because in the end of the day, we're looking at value creation here, and we're looking at value creation there. So when you're analyzing a decentralized application, you have to ask yourself if there's really room for penetration of this specific project. In addition, we also look and gather signals and sentiment from the community. When you think about VC, usually the rounds are only with a few investors, 2 or 3 investors. But with blockchain, it's really crowdfunding. It's incredibly distributed. Kin, for example, had 10,000 participants in over 100 countries. So it's very important to understand the sentiment within the blockchain community, follow on all the social networks, on Reddit and Telegram, and coin farm, and there is a whole universe around blockchain which will boggle your mind if you ever get into it. That is very important to follow. Also, in terms of institutional investors, we're looking to invest with institutional investors. In Kin, for example, we invested with Andreessen Horowitz and Sequoia and other great VCs that know what they're doing. And everything else is, to be honest, is quite similar. We look for a team that is able to execute and that displays real leadership. We look for large market opportunities, technology, business model. When you think about the business model, other aspects to analyze within the blockchain is, for example, how many tokens were issued, what's the supply, is there a cap? And so a lot of the analysis is very similar to kind of monetary analysis. Valuation, asset pricing. So our edge. Our edge is the network that we built, the access that we have to ICOs at a pre-sale price, and people that we know around the world, and involvement in the blockchain community. And of course, the methodology and the discipline and the kind of sitting and understanding the projects that we're investing in, meeting with the entrepreneurs, analyzing all the materials, and making informed decisions. So just to conclude, we wanted to create this meetup to kind of tell you more about the blockchain and why we're so excited about it. And really our conviction in the industry led us to create this product that enables you to participate with us if you're interested. And we'd be happy to accept any questions and stay in touch.